In the alternate version of exercise 3-4, we're asked to prepare adjusting entries for each of these separate cases that are necessary for our financial statements for a year ended December 31st. It's noted that prepaid expenses are initially recorded in asset accounts. Also, fees collected in advance of work are going to be initially recorded as liabilities. Fees collected in advance of work, we normally know that as an unearned revenue. So we record that initially as a liability. Now, you may question, I've already learned basic journal entries. Now you're throwing in a wrinkle. Why do I have to learn this thing called an adjusting entry? Well, any typical business is going to prepare its financial statements on some type of fairly regular periodic basis, at least annually. And a lot of businesses also prepare their financial statements on a monthly and even quarterly basis. Now, the problem is that the things that happen within the business don't necessarily fit nice and neatly and start and stop within those financial periods of either a year, a month, or a quarter. Some things extend into 2 periods or even 10, 20, 30 periods. And so we have to do adjusting entries to make sure that those things that span those multiple periods actually get recorded correctly, and our assets, liabilities, and revenues and expenses record the true financial condition of the business. As an example, let's take a look at B really quick. So we've got some employees that have worked through the end of December 31st. Let's say they worked Monday through Wednesday. Let's say December 31st is a Wednesday. They've earned $3,000 worth of wages. But let's say, on the other hand, that the pay period isn't until Friday. Keep in mind, I said December 31st is going to be a Wednesday. They're not going to get paid until Friday on January the 2nd. Do we just prepare our financial statements as far as December 31st and say, oh, well, next year you'll catch up on the additional, when you debit wages, expense, and credit cash, you'll catch up on the additional expense? Well, that wouldn't be fair. We wouldn't show the true cost of the wages those employees would have earned. So as of December 31st, our income on our income statement would actually be overstated. On the other hand, we also wouldn't show the outstanding obligation or liability, because these employees have worked, they just haven't been paid yet. So there's an outstanding liability, so our liabilities would be understated in our balance sheet. So our balance sheet and our income statement would not be correct. And we can't do that. Just because things span more than one period of time, like the wages here, we need to do adjusting entries to make sure assets, liabilities, revenues, and expenses do show the correct amounts as of the end of the period of time. So any adjusting entry, according to what your book mentioned, is going to affect at least one balance sheet account, and that may be an asset or a liability. It also needs to affect at least one income statement account, and that might be a revenue expense. And we in accounting create a rule and then have to create an exception to the rule. One exception to the rule is we said it has to affect at least one balance sheet account, and that can be an asset, but that asset will never be cash. Adjusting entries never affect cash. So let's start to look at this. And your book has a great 3-step process to try to organize yourself within adjusting entries. And it basically says, look at currently, before you make the adjustment, look currently at where you're at. At that particular account, look at where it stands currently. Step 2 is figure out, what should it really be? So it's here now. What should it really be? Step 3 is just, what entry do I need to make in order to get it from the number it is now to the number it should really be in step 2? Now that sounds really easy, but it's going to be a little bit trickier because preparing the journal entry and picking whether or not it's an asset, liability, revenue, expense that we're affecting really depends on what type of an adjusting entry we're going to make. And we'll see we'll have 4 different choices. For example, we mentioned it has to affect at least one balance sheet account. Maybe we debit an asset account and credit a revenue account. Or maybe we debit a liability account and credit a revenue account. Our third option could be crediting an asset account and debiting expense account, Or last and not least, we might credit a liability account and debit an expense account. Now it's looking a little rougher because now we have 4 choices. Well, the specific choice we need to pick depends upon what type of adjustment it falls within. Is it a prepaid expense? Is it unearned revenue, accrued expense? When we know which exact scenario it falls within, it's a lot easier to pick the combination of accounts that we need to pick. So let's organize this a little bit differently too. Let's think about it. We said step 1 is figuring out our current account balance and what state it's in. Let's say we recognize that our asset balance is too high. So here's our assets, going to have a debit balance, it's too high. We figure out what the balance should be. It's going to be a little bit lower debit balance. What do we need to do in order to get it from a higher debit balance to a lower debit balance? We're going to have to credit the asset account. So if the asset account balance is too high, we're going to credit an asset account. Assets are on the balance sheet. What's the flip side of the entry? Well, let's think about this logically. Assets show future benefits. If those future benefits have decreased, then we've used them up. So the flip side of the entry is we need to debit some type of an expense account to show we've used up a portion of that asset. This scenario is called a prepaid expense or deferred expense scenario. Will always include a debit to an expense and a credit to an asset. Another option is the asset balance is too low. Well, it needs to have a higher debit balance. So what do we need to do? Well, in that scenario, we need to debit an asset account. Well, the flip side of the entry is going to be we'll always credit a revenue account. This scenario describes an accrued revenue scenario. Will always include a debit to an asset and a credit to a revenue account. A third option affects our liability. Our liability account balance is too high. Remember, liabilities have a credit balance is too high. Needs to be something lower. To get it to a lower credit balance, we need to debit the liability account. Well, the flip side of the entry, we need to affect something on the income statement, is going to be to credit revenue. This scenario describes an unearned or deferred revenue scenario where we debit a liability account to lower it and then credit a revenue account to show the revenue being earned. Last and not least is a liability is too low. So the credit balance is too low. What do we need to do? We're going to increase it by crediting the liability account. What's the other side of the entry? We would debit an expense account. This is going to explain an accrued expense scenario will always include a debit to an expense account and a credit to a liability account. So if you understand it, and we had a problem that looked at scenarios and what category it falls within, if you can identify the particular type of category and learn the pattern of the adjusting entry related to it, that can also help you learn the adjusting entries. So let's go ahead and jump into some specifically instead of just talking about them conceptually. So we've got A here. 1/3 of the work related to $12,000 cash received in advance is performed this period. So which of the 4 scenarios does this fall within? This is going to be an unearned or deferred revenue scenario. So initially, we received $12,000 as cash in advance from our customers and debited cash for $12,000 and credited some type of unearned fees revenue related to us, some type of liability account for this. Now, fast forward a little bit in the future is 1/3 of the work really has been completed. So let's think about this. What's the current balance equal? Well, that liability account unearned for fee revenue still has the original balance of $12,000. It's a liability, so it's going to have a credit balance. What does it need to be? Well, let's think about it. If 1/3 of the work has been done, 2/3 of the work is still outstanding. So we take 2/3 times $12,000 means $8,000 still needs to be earned in the future. And 2/3 still needs to be earned in the future. So what do we need to do in order to bring the credit balance from $12,000 down to $8,000? We would need to debit unearned fee revenue, a liability account, by $4,000. Remember, this is an unearned deferred revenue scenario. So we debit a liability account and credit a revenue account. In particular, we're going to credit fee revenue. So if you think about this, what have we accomplished? Well, we've lowered the outstanding liability down to $8,000 because we only still owe $8,000 worth of service. On the other hand, we've recorded that we've earned a third of the work as fee revenue. So we've accomplished both. So let's look at our next scenario. Going back to our wages expense on B, $3,000 has been incurred but not yet paid as of December 31st. Now, I've got some additional details that you won't see in your corresponding problem set. And I want to explain, even though in your problem set you're given that $3,000 has been incurred but not yet paid, you won't always be given that information in the exam. You might have to calculate it. So that's why I added a little bit more detail here in the video to help you understand how I calculated it. Again, let's assume December 31st is a Wednesday and employees normally work a Monday through Friday 5-day work week, and they're normally paid on Fridays for work completed Monday through Friday. Let's also say the company has 4 employees, each of which earns $250 per day. So 4 times 250 per day means that total employees, assuming they all work each day, would be $1,000 per day. So 4 employees times $250 per day times 3 days is how we came up with the $3,000 earned but not yet paid. What type of category does this fall within? Unearned revenue, prepaid expenses. This is an accrued expense scenario. So let's figure out, where does the balance currently reside? Well, wages payable, the outstanding obligation, currently shows a zero balance. What does it need to show? Well, it needs to show the $3,000 credit balance that those employees have worked but have not yet been paid. What do we need to do in order to increase the balance to $3,000? We need to credit wages payable by $3,000. Keep in mind, this is an accrued expense scenario, so the other side of the entry is to debit an expense account. In particular, we would debit something like wages expense for $3,000. By doing this, we've accomplished showing the expense or cost of the employees that work, but on the other hand, show that we have an outstanding obligation, we have not yet paid them for it. Now, again, this is not part of your problem set, but might be something on exam. What happens then on Friday, on January 2nd, when we actually pay the employees? What entry do we make then? So it looks something like this. First thing we need to do is actually show that we've lowered the outstanding obligation. Remember here, we increased the liability of $3,000. Now we're paying it off, so we're going to debit it by $3,000. You may ask, why am I debiting wages expense by an additional $2,000? Well, they worked January 1st and January 2nd. We're mean employers. We made them work on the new year, but to make this situation worked out, but we made them work Tuesday and Thursday. That's an additional 2 days at $1,000 per day. Remember, 4 employees times $250 per day. So that's an additional expense of $2,000 that has not yet been recorded for January 1st and January 2nd. In total, the total amount of cash paid is for the 5 days at $1,000 each, so we're going to credit cash for $5,000. Our next scenario is going to be a deferred or prepaid expense scenario. So we're talking about depreciation on the company's equipment is going to be $8,500 for the year. So we initially purchased the equipment, we debit the asset account equipment for the cost. In this scenario, let's pretend like that's going to be $30,000. Keep in mind, we're going to have that over time. In fact, we identified here that the piece of equipment is going to last us 3 years. We can't leave it on the books for $30,000 indefinitely because we're using the equipment. It's going to have wear and tear. It's going to decline in value over time. And we need to show that cost or use as we're using that piece of equipment to help us earn income, and we do that through depreciation expense. Now, again, in your problem set, the depreciation is going to be given for you. Here it's given to us, it's $8,500. In an exam, you may have to calculate it. How did I do that? The original cost of the equipment is $30,000, has an estimated life of 3 years, and we expect at the end of those 3 years that we're probably going to get $4,500 from selling that piece of equipment. So if I use simple straight line, just even over the life depreciation, I would take the original cost of $30,000 minus the salvage or residual value, what I think I can get from at the end of its life of $4,500. Divide that by the number of years, 3 years, and I would get an annual equal depreciation expense of $8,500. I'm just trying to come up with some systematic way of recording the use of that equipment helping to earn my income over those 3 years. So what's the current balance show? Well, right now depreciation shows nothing. We've not recorded any depreciation. What does it need to be? Well, we said it needs to be $8,500, and that's a debit balance because we're talking about depreciation expense. So what do we need to do? Debit depreciation expense for $8,500. And you may say, well, you said this is a prepaid or deferred expense scenario, so we debit an expense account and credit an asset account, so I'm going to credit equipment, and that seems to fall along with the normal rule. Well, you know, we in accounting like to create rules and then create exceptions to rules, so I'm going to create a little bit of an exception. Instead of directly crediting the equipment account, we're going to credit an account, a new one called accumulated depreciation for $8,500. It's what we call a contra asset account. I know, I'm sorry, we tried to stick with the basics. Now we're adding a bit onto that. Contra asset account means it's related to an asset account, so it's related to the expense, not expense account, but related to the equipment account. The contra part of it means it has opposite the normal balance of whatever account it's related to. It's related to equipment, which is an asset. An asset has a normal debit balance, so accumulated depreciation is going to have a normal credit balance. Again, you may ask, why are we complicating things? Well, we want to continue to show the original $30,000 balance in the asset account called equipment. And because we're just estimating the overall decline and wear and tear on this piece of equipment, we want to show that decline or decrease in a separate account, a contra account called accumulated depreciation, so we can keep our original record of the $30,000 and show the decline in a separate account. So your book also talks about that on our balance sheet, we report any plant assets like equipment, buildings, those types of items, net or of the accumulated depreciation, they call that book value. So on the balance sheet, I would show a $30,000 cost of the equipment minus the $8,500 in this contra asset account called accumulated depreciation. And that would be a book value of $21,500. Again, not asking your problem set, but a concept you need to learn nonetheless. So D, we've got some office supplies with a $200 debit balance as of the end of last year. So we're going to start this year with $200 in office supplies. During the year, we're going to buy $6,400 worth of additional supplies. But at the very end of the year, we go out to count our supplies and we only have $500 left. So where does our office supplies balance start with? Well, it has an unadjusted balance of $6,600. How did I come up with that? Well, we started out the year with $200 worth of office supplies remaining, but we purchased or debited office supplies for an additional $6,400. So throughout the year, so before we go out and do our count, we believed that we had $6,600 worth of office supplies. What should our balance be? Well, it should be the $500 worth of supplies we actually have to carry forward into the future. What do I need to do in order to get it from the initial unadjusted balance of $6,600 to the true balance of what we have left of $500? We would need to credit office supplies directly by $6,100. What's the flip side of the entry? We've used them up, $6,100 with office supplies, so we'll debit office supplies expense for $6,100. Again, I've shown the decline in the asset along with the use or the cost on my income statement. So very similar, E, prepaid insurance. This is another prepaid expense or deferred expense scenario. Prepaid insurance has a $5,000 balance as of December 31st of the prior year. So last year's ending balance is $5,000. That's the same as this year's beginning balance. However, when we get to the end of this year, we determine that we only really have $900 worth of unexpired insurance benefits remaining. So where's our balance currently? Well, prepaid insurance, the asset account, currently shows a $5,000 balance, but that's not really the amount of benefits we have left. We again looked at this and did analysis and figured out the true balance of benefits that we have to carry forward to the future should be $900. So what do I need to do in order to lower the balance from $5,000 to $900? I need to credit prepaid insurance by $4,100. So I'm going to credit the asset account to show a reduction in the benefits of $4,100. Keep in mind, we've used them up, so it's benefited our business. So we're going to debit an expense account called insurance expense for $4,100. So let's look at a slightly different scenario. We had a number of them where we had prepaid or deferred expenses. This is going to be an accrued revenue scenario. So we're going to have earned but not recorded $800 of interest from investments in CDs for the year ended December 31st. So we've had some idle cash, we've invested it, we've earned some revenue, it's just not been paid. It's not going to be paid until January 10th of the following year. But keep in mind, we've earned it over time. What's the current balance equal? Well, interest receivable, what we're due in terms of interest, currently shows a zero balance. What should it be? It should be $800. We identified that's what we really have earned. It just hasn't been paid to us yet. What do we need to do in order to increase that balance? We need to debit interest receivable by $800. What's the flip side of the entry? We have interest owed to us, but keep in mind, we've earned it. We've done what we needed to do, so we need to credit interest revenue by $800. Our last scenario that we're going to cover in this exercise is going to be another accrued expense scenario. So somewhat similar to our wages scenario. But instead of wages, we're talking about interest in here. So the company has a bank loan and has incurred but not recorded interest expense of $1,400 for the year ended December 31st. So in the scenario we just did, we're investing money and earning interest revenue, but in this scenario in G, we're the borrower, so we're incurring interest. It's going to be an expense for us, so we're the borrower in this scenario. Now again, the setup of the problem goes ahead and says, here's how much interest that this is cost for the outstanding number of days has been $1,400. You just haven't been paid it yet. You won't get paid until January 2nd, but you really have incurred it. It's really a cost to your business. Our exam may not be as forgiving. You may have to calculate it. So how did I calculate it? I said the outstanding debt is $210,000. We borrowed the money on November 1st at an annual interest rate of 4%. Well, how did I figure out that we really had incurred $1,400 worth of interest? Remember, take the outstanding debt times the interest rate, and if it's less than a year, times the fraction of a year. You may question, what is this 360? Our particular book uses 360 days instead of 365. It uses what we call the banker's rule, so make sure you use that in your calculations. So borrowing is $210,000 times 4%. That's the same thing as multiplying it times 0.04. Times the fraction of the year out of 360 days. I said 60 out of 360 days. How did I figure that out? It was issued on November 1st. Keep in mind there are 30 days within the month of November. But when we borrow funds or lend funds, we don't count the day of borrowing. So we're going to ignore November 1st And since there's 30 days within the month of November, the debt was only outstanding 29 days in November. Keep in mind, we ignore the day it was issued. However, we're not just looking at November. We also have to add in the number of days in December, 31 days in December. So 29 outstanding days in November, 31 outstanding days in December is where I got my total of 60 days. So 210,000 times 4% times 60 out of 360 days is how I came up with $1,400 in interest owed. So what's the current balance now? Well, before I make an entry, interest payable doesn't show as if I owe anything. What does the balance need to be? We just established that it needs to be $1,400, and that's a liability, so it needs to be a credit balance. So what entry do I need to make? I'm going to have to credit interest payable by $1,400. This is an accrued expense scenario, so I need to also debit interest expense or some type of an expense account for $1,400. Again, think about it. The borrowing has been outstanding. Truly, this is a cost because the money's been outstanding for that period of time. I just haven't paid it yet, so I have to record a liability.